Quick question. Where's your money right now? Not your cash, not your card, your money. The number sitting in your bank account. You're picturing it in a vault somewhere, right? Neat little stacks, maybe with your name on a shelf, a security guard nearby, very safe, very yours. I have some bad news. That money doesn't exist. Not in the way you think it does. And by the end of this video, you're going to look at your banking app completely differently, in a wait what kind of way, not a good way. Let's get into it. To understand why your bank is basically running a very polite, very legal magic trick, we have to go back about 400 years. To London, to goldsmiths. Back then, if you had gold, you had a problem. Where do you keep it? Under your mattress, great, until someone breaks in. So people started paying goldsmiths, who already had strong vaults for their own gold, to store it for them. In return, the goldsmith gave you a piece of paper, a receipt. This paper says you own 100 gold coins, currently sitting in my vault. And here's where it gets interesting. People realized they didn't need to go get the actual gold every time they wanted to pay someone. They could just hand over the receipt. The receipt became the money. So now the goldsmith is sitting on vaults full of gold that basically nobody comes to collect. Days pass, weeks pass, the gold just sits there. And one day, some goldsmith, historians don't know exactly who, but let's just imagine he had a very punchable, smug little face, had an idea. What if I write out more receipts than the gold I actually have? Nobody's going to ask for it all at once anyway. And just like that, fractional reserve banking was born, a system built on a simple bet that not everyone shows up for their money on the same day. That simple bet is still the foundation of the entire global banking system. Yes, today. In 2026. Right now. Okay, so fast forward a few centuries. Governments obviously noticed banks doing this gold receipt trick and eventually built rules around it. The rule was called a reserve requirement, basically, a law saying, bank, you have to keep at least X% of your customers' deposits on hand. You can lend out the rest, but not everything. For most of the 20th century, that number hovered around 10% in the US. So if you deposited $1,000, your bank could lend out $900 of it to someone else, a business loan, a mortgage, whatever, and just keep $100 in the drawer, so to speak. That $900 gets deposited into another bank, which then lends out 90% of that. Over and over. Economists call this the money multiplier. Your original $1,000 deposit can, in theory, turn into almost $10,000 of money circulating through the economy. Same original dollars. Nearly 10 times the money. Now here's the part that should genuinely surprise you. In March 2020, the U.S. Federal Reserve quietly dropped that reserve requirement to 0%. Zero. Not 10%, not 3%. Zero. Banks are not legally required to hold back any fixed percentage of your deposit, at all. The number where your money is definitely, for sure, kept safe just in case, is now, officially, none. Did anyone tell you this happened? Because practically, nothing visibly changed, which honestly might be the scariest part. Here's where most videos on this topic stop. Ooh, scary, banks only keep a fraction of your money, spooky. And then they just move on. But there's a much bigger twist, one that even shocked economists when it was officially confirmed. For decades, the standard explanation of banking, the one probably still in your kid's textbook, goes like this. People deposit money, the bank collects a pool of those deposits, and then lends that pool out to borrowers. Deposits first, loans second. The bank is basically a middleman. In 2014, the Bank of England, one of the oldest, most respected central banks on the planet, published an official paper that basically said, that's not how it works, at all. According to their own explanation, when a bank approves your loan, it doesn't reach into a pool of other people's deposits and hand you their cash. It simply creates a brand new deposit in your account, on the spot, with a few keystrokes. Read that again. The bank doesn't move existing money around when it lends to you, it manufactures new money out of nothing, the second it clicks approve. The technical way they put it, Loans create deposits, not the other way round. So it's not just that banks keep a small fraction of your money in reserve. It's that most of the money in the economy wasn't sitting anywhere to begin with. It was typed into existence. That safe vault image in your head? Delete it. What you actually have is a number in a database, backed by a promise, resting on the assumption that not everyone asks for their money back on the same Tuesday. Which brings us to the one thing this entire system is terrified of: everyone showing up at once. It's called a bank run. And it's exactly what it sounds like: a large number of depositors deciding, all at the same time, actually, I want my money now, and rushing to withdraw it before the bank runs out. Here's the cruel irony: a bank run doesn't need a real reason to start, just a rumor. Just enough people believing the bank might be in trouble is enough to make the bank be in trouble, because remember, the bank never had everyone's money sitting there in the first place. During the Great Depression, this happened at a scale that's hard to imagine. Thousands of banks collapsed as panicked customers pulled their money out, wiping out millions of savings accounts almost overnight. And if you think, oh, that was ancient history, we're smarter now. March 2023, Silicon Valley Bank, one of the most important banks for the American tech and startup world. Interest rates rose fast, a rumor spread, depositors panicked, and the bank collapsed within days. A huge chunk of the money in that bank belonged to businesses holding far more than the government-insured limit, meaning a large slice of it wasn't guaranteed to come back at all. This is 2023, not 1930, the exact same fragile bet, just running on faster internet. Now, before you go pull all your cash out and bury it in your backyard, relax. There's a reason the system hasn't collapsed on a random Tuesday afternoon in the last 90 years. Deposit insurance. In the US, it's called the FDIC. If your bank fails, the government guarantees to pay you back, currently up to $250,000 per person, per bank. It exists specifically because of the Great Depression disaster, to stop panics before they start. Similar setups exist in Canada and Australia too, run by their own versions of this safety net. So for the average person with an average savings account, you're covered. The system is built on a bet, yes, but it's a bet with a government-backed insurance policy stapled to the back of it. The real risk shows up for businesses and wealthy depositors holding way more than that insured limit, which is exactly what happened with Silicon Valley Bank. So let's rewind. Your bank doesn't have a vault with your name on a pile of cash. It never did. Not since some goldsmith in 17th century London realized nobody checks on their gold that often. Today, most of that money isn't even old money moving around. It's brand new money, created the moment a loan gets approved, resting on trust, math, and the hope that everyone doesn't ask for it back at the same time. Wild? Yes. Dangerous? Only if that trust breaks. Is it going to break while you're watching this video? Almost certainly not. But now you know how the trick works. And next time someone tells you the bank is basically just holding your money for you, you can smile and gently explain that it's a little more interesting than that. If this blew your mind a little, you know what to do. Subscribe, and I'll see you in the next one, where we bust another myth history's been telling you for way too long.